Good morning, SMF MMTs in this group and seniors. Tommy Two-Tone, this is your trade. The thing about it is, this is a monthly chart on the S&P 500, and we've been climbing the wall of worry. But let's point out something here. Let's go back and do a little thing. Back in 96, we had that expansion. Bam! We got up there. We hit these double tops before. Financial crisis. Bam! This is the re-leveraging part. What's going to end up happening in the indexes, just so that people understand, is that S&P's up here at that 1343. We talked about our target of 1340, but right below that 1350 handle is where the broader institutional traders, floor traders, whatever inventory they have, hedge fund manager community is going to start to sell into that. And as they start to sell into that, that will mean that there's going to be a tug of war between the bear and the bull. And what will happen is, between the two groups within the Wall Street public community tape, is that they are the upper end of that tape. And basically, they're going to be selling into that 1350 because that 1350 is half of that 2008 down bar on a monthly level. That's your monthly down bar. One of the things that the bulls continue to have going for them, and understanding where that very strong impact of momentum to the upside is, that we must be very clear about the fact that we had a big inflow of money coming into the markets, into the mutual fund community, called dumb money. So basically, because we operate in a completely different fashion, we don't believe the 20-year buy and hold is good for anyone. It's good for them, racking up monthly fees and monthly charges to the public who put their money there. And basically, when they go up and they come down and they go up and they come down, you're just watching your gains go up and down without ringing the cash register. The thing about it is, that bigger community that I'm talking about, that's always trying to get on the other side of that mutual fund community money, is that hedge fund management community, which we have a lot of dealings and trainings with them. We know that there are 3 different levels of institutional type traders, and the tier 1 will be selling into that 1350 handle. Okay, so basically, as they're selling, the key is, where is the buyer going to be to absorb the sells? Now, there are a lot of bearish things that the bear has been on for quite a while, and there might be some truth to quite a bit of it. We do cover it. Some things we agree on, some things we don't. What we do agree on is where the current tape is, where how overbought we are going to be, and where that first distribution handle is going to be. That's the most important thing. The bull side, we'll talk about that first. We have right here, these are called monthly moving average convergence divergent bars. This is a public technical indicator that the public makes their decisions on in the upper community, because that's all they have. Where a market maker like SMF makes their decisions totally different, because what it tells us is that their standard technical analysis versus a market maker who controls the market and the exchanges and the indexes, their operations quite different, as you have already witnessed. So basically, we have a monthly buy signal that is extremely bullish, because when we get these monthly buy signals like we did over here in 96, that's where you get the long-term expansion with economic indicators. But on the other hand, when they top out up here on a monthly level and they start to descend in value, down you go. And I was short in the NASDAQ March 10th, year 2000. Prior to March 10th of year 2000, I was building shorts in the NASDAQ comp and the S&P 500, because everybody was so wound up. And there was the kaboom. Well, we got another expansion in 03 with the Iraq War, and we made the tops up here. And during these years between 04, 5, 6, and 7, the key ingredient for the hedge fund managers is, I want you to listen carefully, and here is what it is. Complacency and fear can remain at elevated levels for an extremely long period of time. That's what happens. Now, in each one of these cases where you got monthly buy signals, they lasted for months. You got a buy signal here again on this date, on 3/1 of 2004. Oh, I remember it like yesterday. When we got it, it kept going, but we stayed up here for a number of months until we peaked on that monthly bar on 10/1 of 2007. And I said, guess what? There was no fear and there was complacency. And we didn't even have a 10% correction in the S&P, and everyone was wondering, well, why is that happening? Why is this happening? Why is that happening? Well, hey, that was that expansion. We were coming off of that big sell-off for a number of years, just like we did over here, except this financial crisis is none like no other ever in history. And when we were short in 2008, you can see where we started to descend. We got our first mustard seed, and I remember it like yesterday. 8/1 of 2008 was the monthly sell signal on the S&P. It never stopped. And we started bottoming out here on 3/1 of 2009. And we called the bottom at that time. This is where we were buying. This is where the wealth was made. It's always made down at the negative ratio because the public doesn't want anything to do with it, MMTs, and they walk away from the market. And that it was the greatest buying opportunity here, just as it was over here. Except the economic expansion cycle is quite different than any other time. The thing that we'll be monitoring is that we start out 2011 right here with the monthly buy signal. Okay? And we are in to the second month of February 2000.